Relative strength index is an indicator that measures strength of price movement. It oscillates between values of 0 and 100, hence is also called oscillator. The way you compute this is that you fix a set of time periods, usually 14, and for every time period, it could be 1 hour, 1 day, etc., or a week, you have an opening price and a closing price. Based on the opening and closing price, you can have a gain when the closing price is higher than the opening price, or you may have a loss if the closing price is lower than the opening price. So you take all these gains and you compute an average of it over the 14 day period or 14 time periods. And then here is the formula for RSI. So what it does is, the formula is like this: 100 minus 100 divided by 1 plus average gain by average loss. So if you look at this formula, if the gain is 0, then this denominator becomes 1. So this term becomes 100, and 100 minus 100 is 0. If the loss is 0, then this term becomes infinity. So that makes 1 plus infinity also infinity. So this becomes 100 by infinity becomes 0, and the maximum value is 100. So the RSI will always fluctuate between 0 and 100. One more thing that one can do is smooth the data. So instead of just looking at current gain and current loss, you could look at the previous values, and if you take previous average gain for the previous time period multiplied by 13, and this previous average gain has previous average gain of that also as a factor, so you can do some kind of exponential smoothing here, but in this calculation we don't do smoothing to make things easier to understand. So let's look at this. So let's say over 14 time periods you had gains throughout and you had no losses, okay, and the amount of gain, we're keeping it as very simple 1. So if you have this, your RSI turns out to be 100. The relative strength is the formula that we use is the average gain by average loss, and this is basically because loss is 0, you can't compute, you can't represent infinity here. And to circumvent that, we have also put an if condition which says that if the losses are 0, then the value is 100, but for all other values it will try to compute. So now let's do one thing. Let's change the 7 time periods as loss and 7 time periods as gain. So we are saying equal number of times one had losses. So you have exactly average 0.5, and the relative strength is 1 because you have equal number of gains and losses. The RSI becomes 50. So 50 basically means that it's midway. Now if you try to increase losses, so let's say you have increased gain, so let's say you have one more gain instead of loss, you will see the number is moving up. Let us put one more, the number is moving further up, and if I put one more, the number becomes 70. So the value of RSI above 70 and below 30 is interesting values that people look for. So when it is above 70, it's called as overbought, which basically means that because there have been lot of gains over a lot of time periods, more number of gains, people have been buying this stock. So it's an overbought. And the other when you have lot of losses and less gains, then you come into the oversold category. Now look at this that we have for simplicity assumed only 1% gain or 1% loss, but it is quite possible that you might have lesser losses in terms of time period, but the magnitude might be higher. For example, if you had 4% loss on one day, so the not just the number of time periods on which you had gains and losses, but how much of gains and losses you had also gets factored in. And in the actual calculation, the smoothing will also happen. So the more recent value is more important than the older value. Older values will still have effect on the RSI being computed.